Are you tired of the rainbows and butterflies approach in multifamily investing, where everything unfolds seamlessly and everybody wins? You never see behind-the-scenes reality. If you resonate with our perspective, acknowledging that true insights emerge from navigating mistakes and challenges, then you're in the right place. Join Christy Keaton, your host, as she dives into the missteps and lessons learned encountered by active apartment operators. In these episodes, we embark on a journey to dissect and analyze the pitfalls within the multifamily project lifecycle, focusing on the crucial stages of finding, funding, fixing, or flipping a project. Instead of glossing over setbacks, we shine a spotlight on them, providing a valuable learning experience for our audience. Each episode concludes not only by revealing how the issue at hand was rectified, but also by sharing other priceless lessons derived from the experience. It's an unfiltered exploration of the multifamily investment landscape, revealing the intricate tapestry of challenges and solutions that make the journey worthwhile.
Stephen Weinstock is a seasoned real estate investor with over 20 years of experience. As the principal of WE Capital LLC, he oversees a diverse portfolio with a focus on multifamily properties. Stephen's real estate journey began in 2001 with a single-family home purchase. He excels in identifying lucrative investment opportunities and implementing value-add strategies to enhance property value and ensure consistent investor returns. He has successfully executed acquisitions in several states, including Florida and Pennsylvania. Stephen has been featured on various podcasts and has served as a guest moderator at multifamily conferences across the U.S. Beyond his professional life, Stephen is active in his Brooklyn, New York community, volunteering with his wife and 7 children. His family's integrity, transparency, and commitment to excellence that define the ethos of WE Capital.
Hello and welcome back to another episode of Multifamily Missteps. This is going to rock your world today. I have Mr. Stephen Weinstock with me, and I am so excited for him to be able to add value to you today. And he has been in the industry for more than 20 years. So I'm certain that he's going to give us a lot of value on the missteps that he's had. Welcome to the show, Stephen. And if you would, tell us just a little bit about yourself, how you got started 20 years ago, and what kept you going.
Sure. So my name is Stephen Weinstock. I am born and raised and currently reside in Brooklyn, New York. Started buying smaller assets in 2001. I made my first purchase of a single family home, $32,000, 10% down, regular 30-year mortgage with it. My plan originally was to buy just one. And, after a couple of months of collecting rent, the numbers started clicking, and we were off to the races and bought another one and kept going. And over the years, my strategy has changed. But real estate is where it's at.
Oh, absolutely. Wow. Yeah, when those numbers start clicking after you see the first one, you're like, wait a minute, I can do this. And then I don't have to have a W-2 if I don't want to have a W-2 anymore, right? Yeah,
Yes.
so I like that as well. The same thing happened with single family flips for me. I was like, wait, these numbers are working really well. So yeah, that's amazing. So over the last 20 years, have you had any missteps that you can tell us about? I mean, you've had a perfect 20 plus years, right?
Sure. There's a very famous podcast who always says, it took me 20 years, but it became an overnight success.
Yeah,
So yes, I had mistakes. I still have mistakes. Mistakes
of course.
all the time, as long as they're not too bad. Time usually heals all mistakes, for the most part. Sometimes you could buy a property, it's not doing well, but if you could somehow hang in, eventually the rents will go up and the value goes up, for the most part, and time heals a lot. Some of the more talented investors are able to make the money much faster. Some of the slow and steady guys, it takes a little longer, but
Yeah, for sure.
for the most part, owning some real estate for a long time solves a lot of problems. So misstep, yes, I had a misstep right out of the gate, actually. It was my second property. This is about maybe 6 months of being a landlord. Like I said, I purchased one. A couple months later, I started looking for another. So this is the first tenant that I put in, not somebody who I inherited. So,
Okay.
I purchased a property, had a vacancy, found somebody to put in, a nice couple. I remember I put them in on a Friday, and I get a call. There was no really text back then. I get a call on a Saturday night. I see a few missed calls, and the woman says, "I think we have to move out." I said, "Oh my God, what happened?" She said, "Oh," and she says it very nonchalantly. My husband got arrested, so and he's going to
Oh,
be in prison for some time. So I say, "Oh wow, well, what happened? Everybody okay?" He said, "Yeah, yeah, no, everyone's fine." But he got arrested for arson. I said, "Oh wow, arson. Where? What? How?" Yeah, the last apartment we lived in. And she ended up staying for a couple of months. She paid the rent. She was actually a pretty nice lady. But I learned real fast not to uh, trust my gut sometimes when it comes to putting in a tenant. Especially back then, I guess my gut wasn't much. I believed every sob story, and that was a first mistake that I remember very well.
wow, wow. So I'm interested to know exactly where the property was. Your first two units that you purchased. Where were those
Sure,
units at?
sure. So I started and I was very active in Trenton, New Jersey.
Trenton, New
This is
Jersey.
the capital of New Jersey.
Mhm.
It's about 45 minutes from where I lived.
Yeah,
Like I said, I lived in New York City. Investing in New York City was, basically off limits, too expensive, too tough, too hard to get into.
yeah.
Uh, Through some contacts, networking, but came across some other investors who were buying in this area, and that's how I got there. So this, my first purchase, and this purchase with this arsonist was Trenton, New Jersey.
So I'm assuming then that we didn't have background checks back then, and it wasn't, as green as we are on our first deal or two, maybe we don't do background checks and we just kind of trust as you were saying, right?
Correct. Now, as far as background checks, yeah, it took me a long time to really to start using to doing that. Now it's a little easier, online, quick. 1, 2, 3, get an answer within a half hour.
Yeah.
But back then, it was more of having to make phone calls to an employer, getting a paper copy of a stub, a pay stub. These days, with text, everything is much easier. And
Yeah.
but yes, I did a lot of that. I was, when I had a vacancy, I would advertise in the classifieds newspaper back then, and I would base my opinions on the people more just than how they communicated with me right away. Did they call? Were they nice on the phone? Were they hard to reach, hard to call back? Did they set an appointment and then call me a half hour later, and they didn't show up because they had a flat tire? So I was able to weed some people out, and I learned real fast how to I guess trust my gut. But yeah, these days the background checks are easy, and
Yeah.
and I do them.
Yeah. So during the application process, when you were brand new, like with that couple specifically, did you? I'm assuming at that point you were still not like there wasn't a paper application and things like that, but maybe there were some references that you could call, or maybe some rental references that you could call. Was that something that ever crossed your mind at that point, or was it
So what I did was with that tenant and the early tenants, I would typically just ask for their previous landlord and try to get some information. It took me a while. Well, I don't know about a while, but when I wanted to get rid of bad tenants, and people would call me and ask for a reference. Not that I would say that they were great, but I didn't want to say too bad about them because
right?
I wanted them out, and if it means offloading them to somebody else, you
Yeah.
know,
Yeah.
whatever it took.
Yeah, for sure. So we've learned, we don't call them bad tenants. We just call them unneighborly.
Okay, unneighborly, right, right.
Yeah.
Yeah,
Yeah.
yeah.
People aren't bad in general. They're just unneighborly, right?
Yeah, 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 exactly,
Yeah,
exactly.
yeah.
No,
So
nobody's bad.
right. So I'm gonna go back um to this couple because I'm so interested because they got arrested for arson on their last apartment, right before they rented from you. Were you able to talk to the prior landlord, and did they know it was arson, from that particular tenant?
So the answer is twofold. One, the number that they gave me turned out to not be the actual landlord. So
Okay.
that was one thing I figured out. But the actual arson, the actual arson took place on that Saturday. So after they were a tenant of mine. So yeah, it literally happened that day. So
Whoa.
yeah, so he went back after he moved out, paid me a security deposit and a first month's rent, and moved in. And I guess he, not that he was bad, but he decided to be unneighborly to his
Neighborly.
previous landlord.
Wow, wow. So you never had a conversation with the previous landlord, the actual landlord then, right?
Never, never.
Wow, wow. But she ended up pretty good for at least a couple of months, yeah, for
Yeah, I mean, she was late always, but she paid and she was easy to communicate with, and she
yeah.
told great, sob stories, and I ate it all up. And but after everything is said and done, she doesn't owe me any money.
That's good. That's good. So she stayed for a couple of months after that. Did you get any phone calls from anybody for them by chance after they moved out? After she moved out? I was just
No, so she actually she moved into a family member not too far away.
okay.
I do remember going to that house quite a few times to actually pick up the rent. I think somebody was helping her with the rent, but
Okay.
after a few months,
Okay.
the money well dried up, and she moved out.
Do you still own that house?
I still own that house.
You do still own that
I
house after
still own that house.
oh,
Yes.
wow.
Yes.
Wow. Well, congratulations. I'm assuming now that you have neighborly tenants that are not arsonists.
Not that I know of.
It's still standing. It's still standing. That's
So
great.
far, so good.
That's great. That's great. Okay, so let's turn a little bit about maybe some more recent because the environment over 20 years has changed a lot, right? So
Sure.
some of the more recent acquisitions that you've done, has there been any mistakes or missteps that you can talk to us about in the industry and the environment that we're living in today that might be able to help us possibly avoid a couple of pitfalls that maybe we might step into?
Sure. So I guess recently, and when I say recently, over the last few years, there are some mistakes. I like to chalk it up to growing pains, or I learned my lesson one time and try not to make the mistake the second time.
Yeah.
Some of these mistakes are cheaper than a Harvard education, so it might be worth it. But yeah, I've made mistakes. I've not adapted as fast as I want to. When I started purchasing multifamily out of state. I was self-managing these properties, so that was a big learning curve. Yeah, yeah, it
Yeah,
was a big
yeah.
learning curve.
Mhm.
Um, Over the years, I tried buying some smaller assets also out of state, and made some mistakes. Typically I ended up at least breaking even. There are times I lost some money on some deals, but some of the big mistakes was on how I approached self-management at first, long distance properties. Now I have it down more to a science, systems in place, people who work for me on a payroll, and I have people locally in my office here in Brooklyn that facilitate some of the management aspects. But I definitely made mistakes.
Yeah.
It took too long to act sometimes. You know, Inherited some problems that I didn't fix right away. Lots of mistakes. That's just on the management side. Sometimes on the capital side as well. Different types of loan products, very enticing. Ironically, when 2008 happened, and you heard about all these people who were losing their properties because of adjustable rate mortgages.
Yeah.
So I didn't really have that problem.
That's good.
The stuff I was buying pre-08 was usually on a fixed loan, so I didn't really have a problem with the assets that I owned. I had some trouble trying to purchase others in a tight lending market, but when I started buying some of the larger multifamilies, yeah, no, I definitely took some loans I was unhappy with, and learned the hard way. There was this one deal we took a bridge debt, a floating rate deal. Early 2022.
Mhm.
Uh, underwrote it for, it was like a 5.5%. We underwrote conservatively for 7%. Next thing you know, things jumped up and it was close to 10%.
Ooh.
And yeah, no, I remember at the time with the bridge lender, and it actually saved us. But at the time when we took the loan out, most bridge lenders were giving a higher LTV loan.
Yeah.
They would do 75 LTV, sometimes 80% LTC, loan to cost. And this lender that we got the bridge loan from, they were, what I thought at the time, were pretty stingy, and they were really holding below 70% LTV. And at the time, it meant I'm getting less proceeds from the bank, and I need to raise more capital from my outside investors to purchase the property. But it ended up helping us or saving us, because if you hear a lot of the problems now that people have with some of the bridge debt on the multifamily, a lot of it has to do with high LTVs that they took out, and obviously now they have a high interest rate, and that they're now trying to refinance into a stabilized loan product, whether it's agency debt with Freddie or Fannie, whether it's a credit union. And these loans are typically going to be a lower LTV. They might be a better rate. In today's market, they might be in the sixes, but they're going to give a lower LTV. And what a lot of these owners have to do to get rid of this bridge debt, they have to put money out of pocket.
Yes.
They have to make that cash call to their investors.
Yes.
So, that's always a tough call to make. And you have a lot of operators who are trying not to make that call. But you have ones that do. And investors don't come in, they get diluted. And you have some people who just can't afford to get out of the bridge loan. But with this specific lender, and at the time we were upset that the below 70 LTV, it ended up helping us. So when we refinanced out into an agency type of loan, it was a cash neutral transaction. Which
that's fantastic.
Yeah.
Yeah, that's fantastic. Yeah, I've seen some of my colleagues actually. They they're at the point of cash capital calls, and I've even seen some of the sellers that I've bought properties from. Right, I've seen some of their properties being foreclosed on due to the lending environment that we're in, and they also took the floating, right, and so they were also hitting the 9 to 10% mark when they actually should have been at the 5.5 to 6% mark. So yeah, I mean, that it's tough. It's tough right now, especially whenever you're looking at your NOI and trying to refinance as well, and the banks are like, yeah, well, you're going to have to bring some cash. And we're not talking, just a couple of $1,000s. I mean, it could be upwards of 500,000 that you're going to have to bring to the table. And yeah, to keep the loan going, or to refinance, or to keep it out of foreclosure. So yeah, it's tough right now. It's tough. So you're in multifamily. So when did you turn into multifamily?
So
You're still doing single family though, right?
So I own a few. I haven't purchased a single family in a long time.
Okay.
Even when I was buying a single family, I quickly transitioned to 2 to 4 units and stayed away from single family. So I did a lot of 3s and 4s.
Yes.
After, I don't know, 7, 8 years, maybe 6 or 7 years, I started buying some 5 units plus, and that was a different ball game as far as lending back then. After the 08 and 2012, 2011, they started coming up with all these DSCR type loans. Yes. So it made the lending easier. They still kept the LTVs at a good, it wasn't pre-2008 with 95 LTV loans, but they made the underwriting process a little easier as long as the debt service coverage ratio covered it. Yep. They would lend it to an LLC, and those loans helped me expand into some of these 12 units or mixed use properties, some retail, some commercial, some office space. But as far as the multifamily, the larger multifamilies, about 7 years ago, looked at different markets, something I wanted to get into for a while. Came across a deal, and took a flight out, looked at it, made the move, and the following years purchased some more property in the same area. And about 3 years ago, started buying in another market in Louisville, Kentucky. Active over there. Yeah. Active over there, and I actually travel there a few times a month. And I'm actually looking for more over there. So if anybody's watching, Louisville multifamily, 100 unit plus,
We'll
reach
keep
out
you in
to.
mind. We'll definitely keep you in mind because I also source deals for syndicators, so keep you in
Oh,
mind.
all right, all
Um,
right.
so oh, I lost my question. Oh, it was so good though. Let me think about it again. So, how big was your first large multifamily? Was it over 100 units?
No, it was smaller. It was
Okay.
40. It was a 43 unit.
Okay.
It was from I don't know about a distressed seller, but they weren't managing the property correctly. They typically owned other types of assets, and this they purchased. It came along with the portfolio.
Okay.
They thought they would try it out, and didn't really work out for them. And
Didn't like it.
I was able to get a great deal on it. And I still own it. It's doing very well. Cash flows very well, and I love the property.
Okay, so you mentioned flying out to Louisville a couple of times a month. Are you still self-managing your properties?
Yes, so I officially
Wow.
self-manage the properties. Now, self-management is different for me today than it was in 2003 when
Okay.
the shower needed to have the hot water adjusted,
Yep.
and I remember going down there and, trying to figure out how to move the regulator under the faucet and all that. Today, it means that I have employees on the payroll locally that work for me and they manage the property. I oversee them. I'm in touch with them daily. It's definitely a full-time job, management.
Yeah.
If somebody says it's not, they're probably doing it wrong.
Right.
Um, I thought about third-party management.
Mhm.
I know to scale, sometimes third-party management is key. But these assets that I'm buying, they're typically C class, B minus sometimes.
Yep.
Big repair and maintenance component to it. And to keep costs down, self-management seemed like the way to go. And I had a background in management, with my other stuff in New Jersey, and a matter of scaling up my knowledge or my expertise into larger.
Yeah, that's great. A lot of us don't want to self-manage, but if you're able to self-manage, that's great. I also asset manage my properties as well, but I don't know that I could like actually self-manage with just the people on site. I believe that for our portfolio, it's better for us to have that third party in place because they have the systems and the processes that they need. And I mean, we keep it. Excuse me, they keep the occupancy up, and they've done really well on our portfolio. We've hit our numbers for our pro forma for the most part. So
Yeah, there's definitely a case for third-party management. I know for sure if you're buying like Class A property, definitely third
yeah,
party is great if you're buying office and retail. When it comes to like C class, there's a case for both ends,
yeah,
and I guess since I have a background in management, I wanted to keep it in house. And
for sure.
sometimes when I look at deals now, and I'm looking at the NOI and some of the expenses from the sellers, and I'm seeing a large repair and maintenance bill, and they're using a third party management. I know that third party management will typically spend more on repairs. Sometimes they'll just replace, they won't tinker and fix. And,
Right.
there's a case for both ends, but, since I self-manage, I try to do it much cheaper.
Of course, of course. And a lot of times that works better for the C class properties for sure, to keep that dollar amount down because you're looking at anywhere from 4 to 8% of the revenue, right?
Correct, yeah.
So that's great. Kudos to you. I don't know that I could self-manage large multifamily, but that is very impressive and congratulations on that. Keeping that money in-house. That's fantastic. So what's next for you in your journey? So where are you going from here?
So I'm still looking to buy more property, regardless of what's going on in the environment. There's always deals to be had. They might be tougher to get. So I'm definitely active, trying to buy something new in Louisville, Kentucky is really where I'm focused at. Um, I had a deal that sort of fell through a couple months ago. But I'm back at the table, sifting through deals, flying down to look at deals, and I'm exploring some other locations. I'm looking into some co-GP and JV partnerships with some other operators to break into some other areas, that they maybe have a presence in, and maybe they, need somebody to partner up, whether it's to raise some capital or some operational experience. I'm definitely active. I'm definitely looking, and Christy,
Awesome.
make sure you find me a deal to buy.
Hey, I'll find you a deal. I'll bring it right to you, Stephen. I appreciate that.
Excellent.
Well, I have 2 questions now that I like to ask every guest and kind of promote other people, honestly. So, besides this podcast, what other podcast would you recommend that people listen to?
So over the years, I spent a lot of time traveling, so lots of podcasts over the years, and there are times I get into somebody and I listen to everything he has to say, and now I can't listen to a word, and I just rotate, and
Yeah.
between. So I've really listened to a bunch over the years, and they're all good. But some of the others, I really like Brian Briscoe, Diary of Apartment Investor. I used to listen to this guy, Dan Lane. He had some sort of, he focused, I think, on the smaller investors. I like Jason Hartman. I like his, he gets out there and really gets in the weeds of some of these numbers, and he brings me perspectives I never thought about. Definitely interesting, fellow. Bigger Pockets, good website. I don't really listen. They're probably great at what they do. I used to like to listen to Rod Cleef years ago. I'm sure he's great and he's doing great things. I just have to be entertained, and just
He's
doesn't.
definitely an entertainer.
Yes.
Yeah.
And I read a lot. I network a lot. I'm very active on LinkedIn, and
Awesome.
trying a little Instagram. But
So one more question is, what one book that has changed your life in the multifamily industry? Just one book.
it's not going to sound like a cliche. It's Purple, Robert Kiyosaki, and I'm saying this even before I read the book, because back in the 90s, I didn't have cable TV, living at home, and they had these like 45-minute or 60-minute infomercials, and they weren't the same ones. I guess they changed it up, and I consumed it and thought about what he had to say, and it really changed my way of thinking. So I only read his book 10 years after owning a piece of property.
Yeah.
It was great, but it was really just the way it taught me, just without reading the book.
That's awesome. That's awesome. I love that. Well, Stephen, if somebody wanted to get a hold of you, how would the best way to be to get a hold of you?
So LinkedIn is easy. Stephen Weinstock, LinkedIn. Website is Weak Capital X. My company name is Weak Capital. My website name is weakcapitalx.com. Stephen at weakcapitalx.com is my email, Stephen with a V. Reach out to me. If you have a deal, you have questions, you want to know which appraiser to use in Cleveland, or which roofing guy to use in Camden, New Jersey, let me know. Reach out to me. I'll try to add value any way I can.
That's amazing. That's amazing. Well, Stephen, thank you so much again for coming and adding value to the listeners. You have added a lot of value and avoided pitfalls for some of these, I hope. Thank you for listening, fam, and we'll see you next time.
Thank you for listening to another episode of Multifamily Missteps. Your dedication to our podcast is truly appreciated. Please help us spread the word and make our community even stronger. The valuable lessons that our guests bring each episode will help you and others avoid these missteps along your journey. Hit the subscribe button, take a screenshot of the episode you just listened to, post it on your social media, and tag myself and my friend Jerome Myers. You never know, you might find yourself our next featured guest. I cannot wait to continue this journey with you. Until next week, stay tuned and stay inspired.